Hello, everybody. Matt and Paul here from Fiduciary Wealth Management. And today's video, we are talking about the Portuguese compliant bond. We get quite a few inquiries about this one, and it's an interesting product for those who are thinking of moving to Portugal or already in Portugal. So Paul, the Portuguese compliant bond, in my experience, the name confuses people because some people think of a bond like a government bond or a corporate bond. Is that what it is?
No, it isn't. But you're absolutely right. A lot of people think it's a Portuguese treasury bond issued by the government of Portugal to raise funds for whatever activity or to fund their deficit or whatever it is. But it's nothing to do with a Portuguese bond. Each country has its own compliant bond. It's essentially a tax wrapper which is approved by the tax authorities in the country in question. So Spain has its Spanish compliant bond, Italy has a Italian compliant bond, the UK has the UK offshore bond, and Portugal has a Portuguese bond. And everything, every territory calls it slightly different. So Portugal doesn't call it the Portuguese compliant bond, which would be the most logical thing. But no, the short name is the Portuguese bond, but it's essentially a tax wrapper approved by the Portuguese tax authorities that offers very tangible tax benefits. Um, so, Matt, can you explain what those benefits are and why the Portuguese bond is a potential vehicle to hold assets and what the advantages are?
Yeah, definitely, definitely. And I think it is aimed at expats and generally for us that's a lot of Brits coming to Portugal and people have built up their investments, their savings. I think for me the Portuguese bond is almost a bit of a combo. It takes a bit from the UK bond and a bit from a UK ISA. It's a wrapper. Um, and you have their investment. So for people who have their investment portfolios in the UK or they sold property in the UK, they're looking for a tax efficient home. The Portuguese bond might be the one for them. So the way it works, as you rightly said, Paul, it's a tax wrapper over a basket of investments. These need to be UCITS funds, but there's a wide range of UCITS funds, which is like a European benchmark for the quality of funds. And why the assets are held within the bond, there's no taxation on that. So um, capital gains tax in Portugal is relatively high compared to other countries. It's 28%, and there's no allowance like we have in the UK, no annual allowance. So if you've got investments in the UK, again, if they're within an ISA, Portugal doesn't recognize the ISA, so that's a open basket of investments which you're going to have to declare annual tax on. You invest in the Portuguese compliant bond, and it has to be the compliant version. There's other bond providers around, and people think you can use one. Again, as you said at the start of this video, Paul, it needs to be recognized by the Portuguese tax authorities. You invest in this bond, there's no tax, no interest, dividend, capital gains tax until you access the capital. So, i.e., you take a withdrawal. And the amount of tax, and this is where it really comes into its own, the amount of tax you pay is reduces the longer you hold the bond. So you take a withdrawal, and firstly, the bond provider will calculate how much of that withdrawal is return of capital and how much is growth. And you only pay tax on the growth element of the bond. Now, as we know, capital gains tax is 28%. And in the first 5 years of that, then you pay 28% on the gains only, but it's 28%. Years 5 to 8, that tax rate reduces down to 22.4. And in year 8 onwards, that reduces down to 11.2. And again, it's on the gain only. What I'm going to try and do actually is if I can share my screen here. Let me see with that. Just to give a very kind of basic demonstration of how that works. we are not promoting our IT skills as part of these webinars, as we can tell, but yeah, hopefully everyone can see that there. So if you look at that diagram that we put together, just using a very simple example, someone invests 100,000 euros, which I think is the minimum. And after 8 years, that's grown by 50%. And then they want to make a withdrawal. So for the sake of this example, they're going to take 15,000 euros. We can see there in the middle of the diagram. So the bond provider realizes that out of that 15,000, 10,000 of it is return of capital, so the original investment, and 5,000 euros is the gain element of it, or 1/3 of the withdrawal. So because this individual has held this bond for 8 years, the capital gains tax is reduced down from 28% to 11.2%. So they pay 11.2% on the gain only, that 5,000 euros. So the tax is withheld, so that's 560 euros they pay in tax, and they receive the net amount, 14,440 of that 15,000. So in fact, that effective tax rate on that withdrawal just works out as 3.73%. So a very kind of simple example there, but hopefully that kind of shows how that works. And in reality, this bond is, very useful for those who are keen to establish their life in Portugal, those who are going to stay for some time. It works very well for those, even if you have NHR. We spoke about NHR before, and there's no exemption for capital gains in there. So people, are taking income via NHR, paying low rates on that, and then reinvesting the money in the Portuguese bonds. But in reality, most investments should be long-term investments, and that's exactly what the Portuguese bond is there for too. Now, you can access the capital before the 8 years. There's not an issue with that, but obviously the preferential rate starts in year 8.
But Matt, for UK nationals, it's quite an interesting structure, because
Definitely.
now with the autumn budget that has just been was announced in autumn, clearly, if in some that there were some changes that became effective 6th of April, which is only a few days ago. Namely this transition from a domicile to a residency regime. So keeping assets in the UK is not a good idea, because notwithstanding this shift from a domicile to a residency regime, any UK citizens' assets remain subject to UK IHT. So rather than keep your assets in a nicer or in another structure, if you've got those assets, you should, and you're moving, already living in Portugal, you should really tidy things up and put it in a structure that is going to provide that tax efficiency. I think it also allows for I think one of the things I like is for inheritance tax, it's quite tax efficient and it's very clean to pass it on to beneficiaries. I think if you return to the UK, potentially they could endorse the policy and make it a UK compliant bond.
Yeah.
But you can correct me, Matt, if that's, which I think is quite a tidy, because sometimes British nationals, for family or for health reasons, decide to return. So they've got that flexibility that they could pivot into a UK bond because it's the same provider involved. Not in every case, but I think in some cases you could do it. I think I do like that. I also like the fact that you can actually pledge the policy as security for a loan. So, if the policy has an intrinsic value, 500,000, you want to raise capital, you give it to a bank, and they may be able to extend credit by taking, how do you call it when it's insurance?
Like a
By
charge on it, was it?
by taking an interest in the policy.
Yeah.
Effectively, they take a charge.
Yeah.
There's a technical word, but it escapes me right now. But it's essentially they've taken a charge over the live policy. So that's quite neat. And I think, Matt, the one thing we haven't mentioned is that Portugal has this quite interesting regime that if you sell your main residence and downsize, you can, or in fact, even if you move to another EU country or buy property in the EU country, but essentially you can avoid capital gains tax. And correct me if I'm wrong, if you downsize your main residence and then the excess capital you place it in a an approved investment vehicle, yeah, which
Yeah.
could be a pension structure or it could be a Portuguese bond. So, you avoid capital gains on your Portuguese property because you're getting old and your property is worth now 2 million. You want to downsize to one which is 800,000 because you don't need so much space. 1.2 million exemption from CGT, and then you place it in the Portuguese bond, which gives further exemptions. So that's
Yeah.
quite neat as well.
Yeah. No, it's true. I think people underestimate the fact that, yeah, we, sell our main property in the UK, there's no capital gains tax. That's not the case in Portugal unless you reinvested in a property. But the alternative is you reinvested in the bond. I think for me as well with the Portuguese bond is actually we've covered a lot of the terms, but in a short space of time. And you know what that is? It's quite a simple structure. For those, if you've got expats and they're thinking, well, I've come to live in Portugal because it's a beautiful country. I want to maybe enjoy our retirement or working out here. A Portuguese bond isn't some kind of complicated thing that's, trying to get around tax laws. It's registered with the tax authorities. As you say, Paul, really good point in the sense that following last year's autumn budget, the recommendation is really to take your assets out of the UK. Um, and yeah, as you say, if you have a married couple, put the bond in joint names, and on first death, it can just continue in the second, and then on subsequent death, it's quite a efficient means to pass that on to beneficiaries. So there are other products, available in Portugal's, and there's kind of pros and cons with all, and that's why, there's no one fits all solution, and that's why we want to discuss these with people who are looking at this. But yeah, Portuguese bond is definitely one that's a good fit for some people.
I think for estate planning, for succession planning, for inheritance tax planning, for a multitude of reasons, the Portuguese bond ticks the box. And yeah, if you're moving to Portugal, then it should be one of a couple of options that you ought to consider in terms of restructuring your financial assets. And even if you've been living for a while, Matt, in Portugal, and now as a result of the UK autumn budget, you're thinking, "Oh Christ, I have got UK assets. I'm going to have to dispose of them to avoid being subject to UK inheritance tax. What do I do with my money?" Well, this is just one route to consider. And equally, Matt, I mean, you're much younger than I am. We don't have to say that
Mm.
in this webinar, but as you get older, you want to simplify.
Yeah,
And you've got a beautiful villa, 300 square meters with a beautiful lawn and so on. But as you get older, you know what? I want something smaller. I don't want 4 rooms and 3 bathrooms and, you know, 1 acre of land. Sometimes you want just less. It is one of those paradoxes of life, that you want to accumulate and then you realize that actually simpler is better. And then you want to downsize. What a wonderful way of downsizing and releasing capital to sustain your lifestyle in retirement. Buy a smaller place, safe in the knowledge that you can do it free of Portuguese CGT. Fantastic. And then put it in a vehicle which is going to enhance your lifestyle in retirement and also be tax efficient. And does the estate planning, the succession planning, inheritance tax planning, Christ, it ticks so many boxes.
yeah, yeah. And do you know what we always ignore? We talk about how tax efficient it is. You know, of course, people have their money, and there's a lot of investment options within the bonds. You can invest in a huge range of funds, which of course we're able to provide the advice on there. So, people have worked hard for their money. They still want to grow it. It's not a case of saying, okay, where's the money that we can make it? It has that combination of growing in a tax efficient environment. I think it does as you say, Paul, ticks a lot of boxes. So good. So if you are heading to Portugal or you're already in Portugal and you're considering your investment options, maybe that's why you've clicked on today's video, then feel free to reach out to us, connect at fwm.gi. Otherwise, feel free to keep watching our videos on YouTube, but if you can like, share, subscribe, feel free to comment on our videos as well, and yeah, reach out when you're ready, and we look forward to talking to some of you. Thank you and
Thank
goodbye.
you. Bye bye.